Okay, if I told you that one of the most controversial fintechs of the last 5 years is setting up for a five times return over the next cycle, that's a 5x return. It's a firm. The company people either love for its vision or doubt for its losses. They're not just a buy now, pay later app. A firm is quietly building the financial rails for the next generation of credit with partnerships locked in across Amazon, Shopify, and even Apple Pay. They're not just winning brand deals, they're embedding themselves directly into the checkout flow of US e-commerce. But there's a twist. The company is still burning cash, and in a high interest rate environment, the market's been brutal on unprofitable growth. So why is the firm still worth watching? They're scaling smarter, and they may be just one product cycle away from flipping the narrative. All the losses that everyone's been speaking about could now just become net income positive and growing. In today's video, we're going to delve deep into the BNPL industry's misunderstood future of this one company that could literally be the next JP Morgan and BNPL. Why a firm's tech stack matters more than its headline losses, that is primarily the most important thing with a firm. And the path that it could take for this stock to move from $50 to 150, $200 even over the next 3 years. All they need to do is execute. That's what they've been doing. They need to just do it for another 3 years, 5 years, and the stock will skyrocket. Let's get into it and let's dig in. And we got Nikhil and Sean here, and they might just join us for the whole interview. So let's go into it and see if both of them can let us know what exactly BNPL is. And we should then head up into something trying to figure out who founded a firm and what his background was and why that is maybe the most exciting part. And I'm pretty sure Sean and Nikhil both would agree that the guy running a firm in itself is a leader and is one of the reasons why we've invested in that. So go ahead, one of you guys, whoever wants to talk about what BNPL exactly is for an average viewer that's heard BNPL for the first time.
I think Nikhil should take it because he like kind of pushed us more into looking into Affirm a lot more than what
Oh
we
yeah,
were
that's true.
before. Like, he's a big Max Levchin fan.
Yeah, I mean, I've heard all the jokes about Affirm. I've seen all the memes on BNPL. Hey, you guys are splitting one burrito into 12 installments, maybe 14 if you want extra cheese and salsa and jalapenos. So I've seen those memes and they're hilarious. And it's true. I think now Affirm's also partnered with DoorDash. So yeah, you can
Yes.
actually split your burrito into 12
Costco.
installments.
Yeah, Costco as well.
But yeah, it's different. There's more to the story, right? There's way more to the story than what we see in the headlines and memes. I think the main thing, let's start with the founder of a firm, Max Levchin. So I think the first time we actually came across a firm back in 2021 and early 2022 was probably when you would I think when Akshat and you were researching PayPal, right? And
Yeah.
then we looked at the whole PayPal mafia guys and what they did, and Max Levchin had a fantastic track record. And we always like to look at very strong founder-led companies, even if once they're listed, that's what we're looking for. And that's
And they were
basically how we
egregiously
came across a firm.
priced in 2021. I mean, to be honest, they were egregiously priced in 2021 all the way up to $176 a share. And they dropped down all the way to
Yes,
the lower teens. I still remember we were looking at it somewhere around the $12, $15 range. It went, I think, all the way down to a single digit, $8, $9 as well. And
yes,
I think we picked it up somewhere below the lower 20s or below 20
yeah.
also.
I think if I remembered correctly, we picked it up somewhere at around $17 and some
Yeah.
change is what I remember.
But we're speaking about Max, right? I mean, now that we brought up the founder itself, he was a Ukrainian Jew that decided to, with his family, immigrate into America when they were just 16 years old, met up with Peter Thiel. And one of the most important things to remember with a firm is that in a BNPL type industry, in a credit type industry, you must realize that your fraud standards, your fraud detection, as well as your credit standards have to be by far bar none. Now, one of the things that made us realize that a firm could be the next behemoth in fintech as well as in the financial institution industry is because Max Levchin was one of the primary founders of PayPal. He's the one that built the credit agency wherein they could put in credit standards for PayPal customers, which was by far maybe the only non-banking platform that could be used to send money to just an email. So imagine if you to just send money through an email, you could have fraud going left, right, and center. But they were able to protect or maybe even make fraud to the lowest levels ever possible on a financial technology basis on a system that has been there through just email. Now, when you're doing that in today's day and technology, you can actually do it to that much of an extent. So it's like saying that you have a Spartan fighting today's wars that are still fought with just sticks and stones, right? It's like having a futuristic AI robot that's Max Levchin for us, who's now building the next generation of warriors. So he's been able to do it back in the 2000s and before. So there's no reason why he's not going to be able to do it with a firm, because that's his bread and butter: payments, financial technology, fraud, right? And that makes a firm a Trojan horse to a certain extent. I mean, I'm certain you guys agree with that as well.
Why would you choose the MPL and not a credit card? Like, it's just so that why we very heavily, why do we really like
So you're right. I mean, BNPL is nothing too fancy. It's basically the concept that the definition of it being buy now, pay later. But the larger story behind it is that you don't want to be caught in a system where credit cards are charging you 18, 20% month on month in order to make a payment that you're deferring over time. So here's the story. You want to buy a $5,000 sofa or a furniture for your, you don't want to put down the whole 5,000, right? So what a firm tells you is that if you're a good credit, if you have a great credit score, you're doing well in your business or in your job, and you have a high credit score, we can now lend to you the 5,000. You just have to put down $500 for the next 10 months. Because let's say your salary is 75,000 USD or 50,000 USD. You don't want to be able to put down 10% of your yearly salary on just one single sofa in one shot. So you want to do it over time. So that's like you're buying it now, you can use the furniture, and you're paying it over time in the next 10 months, 12 months. And there are two kinds of BNPL, right? There's one wherein, in terms of a firm, there's two. One, which is interest bearing, which is where you're saying instead of 10 months, I want to now pay it over 48 months, over 3 years, over 4 years, or over 2 years. So that means you're going to be paying less amount of money for a longer period of time. Now, in order to incentivize the lender, you have to pay a certain amount of interest. So that's an interest bearing BNPL. The flip side is another loan that's available, which is a zero interest paying loan, which means now you're paying the $5,000 so far over 10 months, but you're just paying $500 per month. And everyone should turn around and be like, so who's going to make money in this? Because now there is a situation where you're paying money, but you're just paying 5,000 over 10 months, but you're getting the sofa or the part of the furniture today. So the merchant has a profit margin, and he's able to give certain amount of that profit away to the lender in order to give you that 0% interest rate. So he's able to bring that down and bring it down. So maybe there's something called as a merchant discount rate, which is basically like a 3 or 4%. So on the $5,000 sofa, they give away 150, 200 US dollars to a firm, and then a firm bears the risk of you making those payments. That's why the most important thing is to make sure that you only provide credit to people that can afford to make these payments, which is where the genius of Max Levchin comes in, because he's able to build these fraud reporting systems. He's able to build credit standard reporting. So you know that you're going to make that payment. And that's something that's putting the whole BNPL definition into a situation where you're buying that sofa now, but you're paying it later over the next 10 months. And wouldn't you agree, Nikhil?
Yeah, another interesting, I think the most important differentiation between a regular credit card and a firm or Klarna or any of the other major BNPL players is that if I had a credit card with a credit limit of, let's say, $50,000 and I wanted to purchase that sofa for 5,000, not only do I have to pay upfront for it, once my credit cycle ends by my due date, but if I do choose to revolve it, let's say if I want to pay it down over 3 months, any other purchase that I make on my credit card, even if I pay it in full, as long as I'm revolving that $5,000 on my credit card, I'll be charged interest on my entire outstanding. So that's the main difference. So, like with Affirm, you're able to segregate your debt, and the revolving interest or credit, or the revolving interest that you pay on your credit, does not affect your entire outstanding balance. So, it's that ability to segregate, and that's how major credit card companies make their money, right? Revolving balances, because even if you owe on one large purchase, you're paying interest for everything. Even if you just buy today, you'll start paying interest for it from tomorrow if you are revolving previous credit.
And I think everyone wrote off BNPL as a bubble post 2021, but a firm is generally quietly building the infrastructure of modern credit. And that's something that will make them a top 10 financial institution, maybe this decade or the next, but it is happening. And they're very well on their path of getting there. And I think one of the most important things that we should touch upon this is, after giving you the brief on BNPL and on Max Levchin, is the Affirm card. I mean, that is today's, I think it's one of the hottest topics in fintech in America at this moment, is the growth of the Affirm card. I mean, I know it's just not a product. It's like it's pretty much a wedge in becoming a daily spend utility for everybody, because you can spend anything and everything on it, right?
Yeah, it is. I think Sean can take this one. So he's pretty familiar with it.
Yeah, I mean, the Affirm car was very surprising when they launched. because like you had to. I mean, first of all, to join a firm, I think they are very strict with who they allow people to come into a firm. Otherwise, you have a lot of people who can just join Klarna because they don't mind the BNPL, but they don't mind paying that small interest rate over time. But since Affirm is, you've heard Max Levchin just say that they love the 0%, they love the Affirm users, and now they love the Affirm card, right? Because uh, people just need the Affirm card like a normal credit card. I mean, obviously, there's the BNPL
Yeah.
aspect to it, wherein you're going to pay, say, $5,000 purchase that you've done now, next month, you have to pay it off. It's divided over how many, like 3 months or whatever. But it's a very sought after card, first of all. They have a lot of they have a,
I mean, I know they have a lot of repeat usage as well. I mean, I remember
yeah,
you telling me that they have
I,
a lot of
I
repeat
just saw,
usage,
yeah.
and yeah,
I just saw that they had come out with this presentation, and then they had like what 90% of them come back.
97, I think 97% of
97.
repeat usage.
And now
That's a
they
lot.
just added, yeah, and then I just heard Matthew Levchin just say that they've added the foreign transaction essentially, wherein they didn't want the users to go abroad, and if they like something, they don't want, if they're able to tap it, and it says, oh, your transaction is not able to go through. So I think they're rolling out more features, and the foreign transaction thing makes a lot of sense because
Yeah,
BNPL, I think for now it's just a North American thing. I mean, it's coming to Europe. They are moving to London right now,
yeah,
but it's very European thing. So if you come to like say Japan and you wanted to buy something that's expensive, I think the Affirm card is going to stand out really, really well. And I'm pretty sure only really they make sure that not all the Affirm users get the credit card, which is really good for an investor standpoint. Like if you're top tier quality customers, you get those cards, and they're like I think they might be as rare. I'm just guessing as the Black Amex, but I
yeah.
think
At the moment, they would be. That's pretty true. I think they have about 1.9 million from what I heard, but that's their fastest growing segment. About 100% growth in the number of cards year on year. And here's the fascinating part. Max did come out and say that they're taking it slow and slowly and then growing it gradually with a hockey stick kind of approach. Because it's important to remember that as you roll out cards, you're also giving credit to people. So you want it to be within the credit standards that you have and within the fraud standards and fraud protection standards that you've created within the company. So that is very important because you don't just want people to come and swipe, use the money, and then not pay.
and I just want to say one small thing. Like what I like about the credit card is I don't think there's any fees for getting those
Yeah.
cards.
Yeah.
For example, right now I just got offered a credit card, and I kid you not, he's like, oh, because you spend a lot abroad, he has this new card with like 1% forex or whatever. But he's charging me like $120 a year just to maintain that card. I'm like, it's a
Yeah.
joke. It's a joke.
Yeah.
I
So
might as well have something like a firm that cuts my credit into like four different tranches at 0% interest rate. I think it's a fabulous, fabulous company and fabulous card to have as compared to a
Yeah,
credit card.
just one more thing, just to add to what Sean said. Another thing I think unique is their underwriting. I think from
mm,
what I understood, they write, I mean, their algorithm underwrites each transaction individually. Like, for example, if I had a credit card worth $100,000 in credit limit, I might not have the ability to pay that down at the moment. But since I have that limit, the bank's going to actually allow me to use the entire 100,000. Now, while you do have an allocated credit limit with a firm, each transaction is underwritten individually based on your historic purchases, your repayment patterns, and the bank's overall risk appetite for that particular quarter.
yeah, that's true. I mean, I do know that in their current shareholder letter, Max did mention that even the loans that you're talking about exactly, which technically to some extent are the 0% APR loans, which is basically we're not going to charge you any interest and we're going to take the discount rate from the merchant and pay from the merchant. We're going to get paid from them. Is their secret weapon. 0% APR loans are their secret weapon per se. Nobody understands that better than a firm does because they're able to do it at scale. And their biggest customers today are prime and subprime, which basically mean that even with prime and subprime, they're able to get their money back and keep growing their revenues. Their revenues year on year have grown 33, 34%. But their revenue less transaction cost, which means for their money that they're making less transaction, but that's up 53%. How many companies do you know that's growing their revenue at 30%, revenue less transaction costs at 50%? Their GMV is growing at 33%. That's their total gross merchandise volume. All the sales going through Affirm's platform. You buy $100 dress, right? That comes up in your GMV. So their GMV is growing over 30%. But out of that $100 dress, how much does Affirm make? And then that's growing by 53%. Whenever you see a company whose revenue less transaction cost is growing more than their total market size is growing, that's a winner. That basically means they're eating into market share. And that's what's happening, right? I mean, I remember, Nikhil, today itself, you sent me a link saying that Klarna's losses have widened. The fact that Klarna's losses have widened and a firm's profits are zooming, it shows you who's winning and who's taking market share.
Yeah, it also speaks to a little bit. I mean, it also says a lot about the European market. But yeah, but that's true. I think one question which a lot of people had, and even I had this question. I remember asking you about this too. So again, this is about 2 years ago when we were like, "Hey, I'm sure someone's taking up the tabs for the interest rate, right? So nothing's free. There's no such thing as a free lunch. So for our users out there, if it's 0% interest, who's paying for that line of credit then?
Yeah. So in essence, let me give you a simple example. Let's say you go in to buy $100 Gillette razor pack with 16 cartridges from Costco, right? Let's say you're buying five of them or whatever. You're just buying something worth $100 from Costco. And you use your Affirm card, or you pay through Affirm because now they've partnered. Costco and Affirm are now together. So you're still going to be paying the $100 only when you take the 0% loan. Technically, Costco would be losing something because they're going to be getting their money slowly over the next 6 months, right? But Costco does get a revenue of $100, which maybe they were not getting because you might have gone to your local supermarket close by and bought yourself those Gillette razors today, but you're going to travel all the way to Costco because you know your $100 razor or your $100 drink or your $100 wine bottles or your $100 whatever dress that you want to buy can now be put on the tab of the retailer. So the merchant is the one providing something called as a merchant discount, which means for every $100 dress, 5%, 3%, 4%, depending between a firm and Costco or a firm and the merchant, is paid by the merchant to a firm. And a firm bears the responsibility of paying the merchant over time. So a firm uses funding capabilities and pays it down slowly, right? It's simple. Imagine you took a housing loan, right? This doesn't happen, but if it did, it's great for the world, but it won't. But here's the thing. If you buy a house, you're paying a loan over 20, 25 years and you're paying interest, right? Over time. The only reason you're paying interest and over time is because real estate appreciates in value. When you buy a dress or when you buy something else, it depreciates in value. So your $100 dress might be worth actually only 20 or $30 by the end of your time. So you obviously want it to take its time and you want it to go, you want to pay slowly for it because it's not an appreciating asset. While money lying in your bank can make you some money as well, right? You could use it for liquidity purposes. So at the end of the day, to answer your question, the merchant in itself, which is the retailer, your Zara, your H&M, your Costco, your Shopify, your Amazon, these guys are paying for it. These guys are the ones that are giving in the merchant discount.
The merchants get volume, they increase the volume in terms of sales.
Exactly.
Their
Exactly.
revenue increases, their accounts receivables just become a little longer. That's about it.
Yes. And that's what's scaring people, right? That because see, no one's understanding the crux of the power of a firm. The reason that they're able to go at 53%, becoming net income positive for the first time this year. In next quarter, there'll be a year of net income positive. Are you telling me that someone that gives loan is now making a profit? The only reason he's going to make profits is because he's good at what he does, right? Why do banks make money? Because they're able to give you money on a loan at a higher interest rate than what they pay us for keeping our money in the bank. That difference is what the bank keeps. That difference is a firm. A firm keeps that. But they're not charging you late fees. They're not charging you any other extra hidden costs. The reason being, a firm's goal is to provide honest financial products. That's Max Levchin's goal. He's the guy that created PayPal. He doesn't need the money. He has enough money. He's also, for a lot of people that don't know, he's also been invested in Evernote in the seed round. He's also invested
Wow.
in, yeah, he's also invested in Yelp in the seed round. So he's made a lot of money. He doesn't need. These are guys that are driven, which is the companies we like, right? Founder-led companies where the guy is working day and night, irrespective of the billions in his bank, purely because he wants to take his company to the next level. We want to be there on that rocket ship in order for us to make some money as well on that, right? And
Yeah,
that's
absolutely.
something
The
that
track record is like super clear. Like especially in tech
exactly.
companies, founder-led companies have usually outperformed installed management or externally installed management.
Yeah, true. And that's something that's happening. And the beauty about it is the way they've partnered up with Amazon and Shopify. I mean, The way they've done
Costco, I think,
those
is the
two,
bigger one.
sorry,
Costco is the biggest one, right?
Costco is the biggest one when it comes to the new partnerships that they'll have, but Amazon and Shopify have a vested interest in the company. So Shopify owns 9% of the company of Affirm. So every time that Shopify grows, Affirm would grow as well. Affirm is the default buy now, pay later option for Shopify. Amazon has vested interest by making Affirm their BNPL provider. So in America, whenever you're buying something on Amazon, you have the option of paying over time and Affirm would show up there as well, same as Shopify. 9% of the company, like I said, is owned by Shopify. A total of 5% eventually, once vested, which is once a certain number of years pass by, Amazon will own about 5% of the company. Now, let me make all of this simple for everyone.
They
If
still have a
9% of the
partnership.
company is owned by Shopify and 5% of the company is owned by Amazon, do you really think these guys are not going to focus more and push more of a firm out there? Right. Sean, sorry, you were saying something.
No, I'm saying they still have the ongoing partnership with Walmart as well.
Yes, but to some extent, Walmart's deal is now a little under the water because of Klarna coming in there. Because Walmart's
Yeah, but
trying
they
to create
still
its
have,
own BNPL,
they
but
still
it's still
have,
there.
yeah.
And the stock took a very big loss when that deal was spoken
Yeah.
about. But that's 2% of their gross bookings. That's it. It's a drop
Another
in the ocean.
notable deal, yeah, another notable deal was when Affirm essentially replaced Goldman Sachs credit card with Apple, because I think they have
Yeah.
like a partnership with Apple right now.
Yeah.
Because Goldman Sachs, being, historically they've all been great at investment banking, and this was their first adventure into retail banking, and their credit division took a massive hit, and they were not able to deal with those losses. And I think now Apple officially has a partnership with the firm as one of
Yes.
the payment providers at the checkout section.
And the
Is
second
it
partner
coming
is
out?
Klarna. But here's the fascinating part. If Klarna starts showing delinquency rates that pick up, bad loans being given out and losses, it's very easy for Apple to just pull out and give that entire market share to a firm because Apple doesn't want its name to be spoiled. Apple Pay is one of the largest payment providers in the world. The last thing they want is to deal with companies that are loss making. So if you think about it, a firm has a lot to gain in their competitor losing billions and billions of dollars because that is the market share that they can gain, right? And I think the Affirm app as well, it's literally becoming the gateway. And the amount of AI and machine learning that a firm has been working on since AI became cool has been monumental. You can literally go onto the Affirm app, type saying, this is the dress I want to buy, this is the shirt I want to buy, this is the suit I want to buy. It's for so many dollars. How long of a period of time can you give me a loan for? And right there you have your answer. Right. I mean, they can just it's like a discovery function for them. It's that strong with the integration that they have with next generation AI. And Max from the PayPal days he is one of the PayPal mafia. He's if not the top. I think from what I remember, he and Peter Thiel were the first two guys that founded PayPal. Elon and everyone came in later, but these guys started PayPal for the first time together. And I think I think it was Sean that was telling me that one of the ideas that people had was just to type there saying, "What's the smartest way to buy this $300 item?" And Affirm hands everything up to you. Right? It's just like magic.
Yeah, I
It's
mean
zero
the
percent.
the app is not just an app to basically view your regular credit card apps where you can view your recent transactions and payment schedules,
Yeah,
but it's actually a marketplace.
that's true.
And the company's financials also is great. Like, forget about the 0%, what they're doing. They're managing the company in a brilliant way, which I think we still like. Even though we had a little bit of an issue with it being a very high beta stock, but I think if you look at it fundamentally, it's a beautiful, beautiful company. It's only 17, and that's nothing compared to what they are doing right now.
I think we have
I
some
think both of
slides
you
to
guys
sort
would
of
agree
give
with me
some.
saying that it could be $100 billion business.
Yeah,
No reason why it
absolutely.
couldn't.
I mean,
They're
yes,
moving now to
the way I look
London.
at it is just maybe like I don't know if Amex is the right card to compare it to, but it's genuinely like a credit card company in its very early stages, and these are very very unique business models because credit is here to stay. I don't think credit is going away anytime soon, right? So it's there. I think we also have some slides to sort of look at some of the revenue growth and some financial metrics, right?
Yeah, so I mean, let me just do it briefly. The charts would pop up anyways. Their gap profitability is growing at about 40% year on year. And GMV is growing at 36%. GMV being the gross merchandise volume, the amount of revenue sales going through the Affirm platform. That's not the money that Affirm makes, but it's the total sales that goes through the platform. Just in the month of April, they've grown by 40%. That's saying something. The whole GMV is grown by 36% YOY. April alone has grown 40%. 0% loans that they have, right? These are these 0% APR loans that we talk about. There's been a change in that mix, and that's led to the fact that the margins are holding. And this has been an decreasing rate environment that the margins are still holding, right? I know they partnered up with a lot of banks and financial institutions. They have off balance sheet ABS deals going on. The funding is solid. The revenue less transaction costs. That is the metric that most of the guys look at. How much money does a firm make minus the amount they got to pay? That's their revenue less transaction cost is moving faster than their revenue growth, their GMV growth. It's just magical. I mean, some of these numbers. I mean, another number that everyone should talk about. I mean, Nikhil, you can just go ahead with it. Is the reserves that they have for credit losses, right? The delinquency rates.
Yeah. So, one of the interesting things is like a lot of this was one of the main criticisms of Affirm. I think we've constantly seen this on the news, or if not on any news channel, it's Bloomberg or CNBC. They were like, hey, are you lending to distressed buyers, right? Is this essentially the next credit bubble? But that's where things get a little interesting. So their delinquency rates consistently, in fact, they've actually reduced their delinquency
Yeah,
rates historically.
over time has been
So
reducing.
yeah. And obviously, they have two metrics because they did have a partnership with Peloton, which did not pan out that well because
Yeah.
there were some impacts for that. But if you actually look at ex Peloton delinquency rates, they've all essentially been below 3%. And that's consistently, and we're talking from 2019 through 2025. The highest being somewhere closer to maybe 3%, I think 2.5 or between 2.5 and 2.9. And their lowest, yeah, somewhere in FY20, end of FY 2022 or 2020, sorry. So closer to about 1 to 1.5%. So super low delinquency rates. So if people are saying there's a risk, we don't see it in the numbers. So we're talking about 30 plus days of delinquency, which is basically where people do not pay their dues for 30 days in a row. So if my due date for the EMI is today, I don't pay for the next 30 days. So that's how they're calculating their 30 plus days of delinquency.
Yeah, that's been pretty, I mean, it's been pretty stagnant at this current levels. I mean, I'm not looking at it from an aspect of there's some form of seasonality that always happens as you get closer to the US tax refund season. Delinquency rates drop. Delinquency rates for everyone that's listening in and is still wondering what it is, it's basically how much percent of that of their total loan have people not paid back. So post 30 days of paying a loan, if you were supposed to pay your loan on April 1st, your loan installment, but now it's May 1st, that means you have not made the payment, you're 30 days delinquent, you're 30 days late. Just shift the word of delinquent to late, and you'll be able to understand what I'm trying to say. 90 days delinquent means you're 90 days late. All said and done.
Yeah, also, just a small clarification. It's like I think it's like 30 plus days. This also includes 60 and 90 days. So by 30
Yeah,
plus,
yeah,
they're
yeah,
basically talking
absolutely.
between the 30 and 90-day window.
True, true. And all said and done, those numbers have been exceedingly stagnant or falling, including the fact that we are at a very high interest rate environment compared to the yesteryears. We don't have lower interest rate environments at the moment. So the fact that just goes to show that their credit quality and their reporting standards, as well as the way they are able to judge the ability of one of their users paying them back is brilliant. I mean, it's just
Could we
absolutely
quickly touch
perfect.
on how they're growing? Because I think it's also because their ability to sort of warehouse loans in their partnerships in order to do that, that's also a way they're actually able to grow without able to borrow more money on their own balance sheet. So can we touch on this whole off balance sheet lending concept?
I mean, the whole off balance sheet lending concept for these guys is that they're able to take in. I mean, for the average viewer, it would be a little too much to dig deep into, but let me just give a smaller example. The only way that a firm is able to write loans is if bigger financial institutions provide them with funding capabilities. These funding capabilities are basically your bigger banks giving a firm money to say, you know what, you can give it out, or bigger private equity companies or anyone with a large amount of money. Large institutions have come in and say, here is 5 billion, here is 4 billion, and give it out as loans because you can give out loans better than we can. So they're able to basically get that money from there and give it out as loans. Now, simple example, when you're buying that $100 dress and a firm is taking on the risk of trying to pay the retailer back, he's taking on the risk, right? The company itself. They do get the $5 that's profit, but the $95 still needs to be paid back. So they can take this $95, and because their underwriting skills are so great and their financial credibility is so great, they can do something called as off balance sheet lending, which is then take that amount of money and give that to another financial institution that might require those kind of metrics in order to get the money out. So it's not a risk on their books. And if it's not a risk on their books, it should not be a risk on the stock price.
Yeah. That's true. So it's a pretty interesting concept. So they can actually grow without taking on excessive risk on the balance sheet, and they can spread it across multiple lenders, right? So it's a lot like reinsurance companies for insurance companies.
That's true. I think we should do speak about, I mean, we don't want to give everyone just a rosy view of everything that's happening. There are some risks in this. From my point of view, I mean, we all can go ahead and give out the risks that we believe in. One of the biggest risks that I do believe is the fact that if we do enter a situation where inflation starts picking up, some of these tariff kind of scenarios cause us to have inflation set pick up, even though tariffs not the big word right now, but fair enough. But even then, you have an inflation rise, you will have interest rate spikes, you'll have the 10-year bond yield head up. People need to make higher payments, interest payment delinquency rates can pick up, people will pay late, and that can start affecting a company like a firm who does not charge late fees. So they're making their money on the fact that people pay them back. And if the consumer is strained, it'll be tough for them to pay back. That is something that, according to me, is a risk. I mean, I do know there are some risks about them not becoming a bank. You guys can touch on that as well.
Yeah, I think I'll let Sean take this one.
I mean, the bank thing is pretty much something that I know has been going on for a while, but they've been clear. I mean, I remember Sean and me talking about this fact also that Max was not looking at getting a charter, a bank charter, because they just want to stick to their core concern, unless and until they're going to be putting in more products or adding a few things. I mean, regulation, I think, could be a risk that Sean was telling me about. I remember regulation being something that could be there under the new administration.
Yeah, I think right now they're just focused on what growing more and more users. I think um, from what I've heard before was they had a very few amount of people on the card, the Affirm card, and now they're pushing more and more, right? Because they don't want. They're obviously very concerned about who they let into Affirm. I mean, it sounds like a cult more than a BNPL
Yeah.
company, but I think right now they're still growing more and more. From what I've heard, Max Levchin was super pumped up about doing small things like adding forex. You're able to tap the card abroad.
Yeah,
Right now,
that's
I
the big
think they're
one.
spreading more and more to London. He's spending a lot of his time in London and Europe, which essentially shows that he's trying to just essentially not become a bank, but trying to get BNPL out there throughout the Western countries and grow that first before they even become a bank. I think they might be a bank if they're really solid
I think if
as
they need
compared
to add
to,
more products, that would be something when they would.
yeah, yeah.
I
But they
think the other
not
thing
be
is
like,
like you can't grow so aggressively if you're a bank because you obviously have cash requirements as a bank. You need to maintain your ratios. There are a lot of regulations. But if a
you
private
might end
credit
up
lender
being
just comes, then you're just making money off your spread. So you can sort of grow without having that sword of regulation hanging over your head.
you
Yeah,
might
that's
end
true.
up being like those Silicon Valley bank. You might just become bust one day,
Yes.
essentially. And I don't think Max Levchin wants to take that risk. I mean, not like
Yeah,
they will
true.
go bust.
And one of the things
And
that I
let's be
know a lot
frank,
of
as
investor
long as they're
community.
growing,
Yeah, sorry.
no, I was just saying, as long as they're growing, I don't really think end of the day, investors are concerned about top line and bottom line growth. I don't really think they care if they're getting there via banking license or via making
Yeah,
spread off private credit. So that's fine.
that's true. I mean, they didn't become a $20 billion company with a bank license. They've become without a bank charter.
Did we just get a Klarna's earnings like come out right now or something?
Yeah, which
And
was a
then
loss
they,
widening purely because of their restructuring costs, and they've been delaying their IPO as well. So, I mean, if they were listed right now, they would have got hammered today. That I'm certain about. Right.
They were about to.
One of the risks that I'll just get back to, because a lot of the investors within the Affirm space worry about, is partner banks. Who are these banks that are giving them loans? And one of the banks had gone bust last year during the Silicon Valley, last year during the Silicon Valley bank crisis. And that started affecting a lot of investors. But just to give everybody clarity, they just partnered with FIS for their cards. Now, FIS is one of the biggest companies out there in America. That is just water under the bridge. That's not something that pretty much anyone needs to worry about. But again, all being said, a firm isn't just selling credit. It's literally building rails for the next generation of digital spending. I guess the market may not get it yet, but that's exactly why there's opportunity. If the market does get it, it's not, we all wouldn't be making money on it. Right. If this thing works, it doesn't just grow, it's going to compound in value. Right. I guess all the viewers can let us know in the comments, is Affirm is the real fintech sleeper, or is it a bubble waiting to pop? We do believe in the former rather than in the latter. So make sure everyone just likes, subscribes, hits the bell. We've got more conviction driven stock deep dives coming pretty much every other week. I think that's the plan.
Yeah.
Anything else you guys want to touch into?
The only thing I would say is, look, if you're an investor in a firm, I think the only thing that's important to highlight is you got to be very patient. It is
That's
a
right.
very high beta stock.
Yeah.
A lot of volatility, a lot of pain in the short run. But yeah, there is it looks very promising, mostly because of the management and what they're doing in the space.
Yeah, but we saw Affirm go from where?
Yeah.
From like
So
what,
it also
12?
depends on what price did you buy it. But
Yeah.
yeah, it is a very high beta stock.
Yeah, I
Yeah,
don't
but
know,
there's
but it's going
still
all
a
the way
lot
from
of,
like single digits to $82 this year, and then back down to 35.
Yeah.
yeah, but
We
I
need a
still
lot of
think I,
guts in the
So I
stomach.
think
we
today it's
can,
around
yeah.
50, I guess. But yeah, you need to be able to stomach that type of volatility.
Yeah, by the
But
time the
yeah,
video comes out, it
there's
could be 48. So who knows? Right.
that's true. We should also do like an
Or
Affirm versus. We
48
should
or
actually
the
do one
85.
video where we compare all the BNPLs too, and
Yeah,
see
we could
what's
do
out
that
there
as
and
well.
how they
I
sort of
mean,
stack up.
maybe let us know all the BNPLs that you guys think are worth looking into, and then we could stack it up and do it on a chart-based scenario.
Yeah. But
Anyways, guys.
I think we need to cover different stock also. I think Reddit is what I think I like a lot
Okay, so let's
also
do
as a
Reddit the
company.
next one. That
Well, so
sounds
I got to go
good.
split my coffee into 6 payments.
Okay, great.
I will see you guys in the
See
next
you guys.
episode.
Enjoy. Take care.
I'll see. Thank you.